Hello, everyone. Welcome to video 3 of chapter 1, module 1. Um, I've mentioned several times the discussion that those who need to pay taxes in Canada are residents and non-residents. So today's lecture is going to be going through how do we decide who's a resident and who's not, and go this video specifically has quite a handful of exercises for us to try our hand at the thought process in determining if someone's a resident. I'll go over a little bit as to why we care about whether or not we are a resident. So there's two sets of general rules for tax liability. The first is residence. If you are considered to be a resident of Canada, you need to record all your income wherever you earned it around the world. If you are a non-resident, then Canada only requires that you report and pay taxes on Canadian income. This can be employment income you earned in Canada, if you have business activities in Canada, or if you disposed of a taxable Canadian property. Let's say you own some Canadian real estate and you sold it. Since that land is here in Canada, it is Canadian property. So residency is determined on a factual basis or can be deemed. So, what they're trying to establish is the rules we're going to talk about are trying to figure out someone's intent. Or do they intend to live in Canada? Do they intend to move away? The thing about trying to figure out someone's intention is it's hard to establish that concretely. Someone's intentions in their head. I don't know what was going on in your head. So what I'm going to do is I'm going to look at your factual situation and see if you have enough things tying you to Canada. We call them residential ties. So factual residency differs between individuals, corporations, and trusts. For the purposes of this course, we are going to focus on residency for individuals. We're not going to do too much into corporations and trusts. Corporations and trusts, because they are legal entities, we pretty much go to wherever their brain is, wherever they're making decisions. So if the board of director is in Canada, the corporation's probably a Canadian resident, right? Because the people in minds who are controlling that entity are in Canada. If it's a trust, where do the trustees make their decisions? Where's the brain of the trust? But for individuals, we have a lot of situations. I can live in Canada. Let's say I had a client once who grew up in Germany. He retired in Germany and moved to Canada. He just wanted to live here in his retirement, but he was still collecting a German pension. So he was in Canada, but all of his income came from a different country. So for individuals, we want to figure out where do you call home? For the other two, where's the brain? For individuals, where's your home? Deemed residency has to do with specific rules, and I will get into those later. So, tax payable and income tax shall be paid as required by this act on the taxable income for each taxation year of every person resident in Canada. So person is talking about an individual, corporation, or trust. We're going to be talking about individuals. For individuals, the taxation year is usually the calendar year from January to December. Corporations can choose an off calendar year, but most tax years are the calendar. In the US, individuals are taxed on citizenship without regard to residence, but Canada, we care about residence without regard to citizenship. So if someone is a US citizen who lives as a resident in Canada, the US government says you have to report all your income here. Canada says, well, you have to report all your income here. And so we're going to look at the tax treaty to make sure that that person isn't double taxed, right? So US and Canada has a very close and very in detail tax treaty. Taxable income of a taxpayer is a taxpayer's income for the year plus additions and minus permitted by Division C. Remember, Division B looks at our net income. Division C is figuring out how much of that income is taxable. The term income usually uses the term net income when referring to Tax Act 3. Tax Act 3 is the section of the Tax Act. The Division B of the Tax Act covers multiple sections. Tax Act Section 3 is often where the discussion around computing net income comes in. So net income for tax purposes will be used to differentiate between net income for income tax purposes and net income for accounting purposes. There's not a lot of times within this course where we need to differentiate between accounting and tax because we are focused on the tax side. But for accountants dealing with corporations, the corporation you work for, or if you're doing year ends for corporations as a public firm, we are constantly defining here's your accounting income, here's your tax income. They follow different rules. Division C converts net income to taxable income. So individuals use the tax year of a calendar year. Corporations, any fiscal period that cannot exceed 53 weeks. And we also have GREs. GREs are graduated rate estates. They're often created at the time of someone's death. So I pass away, my estate is a trust. So that trust will follow the same graduated rates, that same bracket rate that I is in, maybe not the same rates, but the same structure as going through income brackets that I as the individual used. Types of income. So types of income we're concerned about is usually employment income, business income, or dispositions. This is for non-residents. Remember, their Canadian income is what's taxed. They will have to file a tax return. And when computing their taxable income, most deductions are available to them. So if there's expenses incurred in order to gain income, so if they have a business, they're allowed to expense their rent for an office space, the salaries for their employees, but they're not going to have access to most of the tax credits. Tax credits are tax expenditures meant to benefit those who are residents of Canada. So non-residents can have the deductions, but they often lose out on many of the credits. So for that reason, so as a resident of Canada, I have to report all of my worldwide income, but I'm going to have access to all of the benefits and credits. Yes, employment income for non-residents, income earned by a non-resident while working as an employee in Canada. We do have a lot of people like this. There are a lot of people of US citizens who live along the border of Canada, and there's many who cross over the border to go to work. They're subject to Canadian tax on Canadian employment income, but they're not taxed on other sources of income. It's recognized that they're just crossing the border to get to work. So even though they're in the country a lot, we still consider them non-residents. Business income for businesses carried on and dispositions. When we talk about real property, we're often talking about land and building, but some capital property and inventories of a business. So maybe I was carrying on a business, earning business income, and then I sold that Canadian business. Well, that sale, that getting rid of that property, does fall under as a taxable Canadian property. Part 1 does not apply to non-residents for investment type income, rents, interest, dividends, or royalties. This income subject to withholding tax. Tax treaties sometimes reduce withholding rate to below 25%. So what this is saying is generally when you have a paycheck in Canada, your tax amounts are often deducted from your paycheck and remitted for you. But non-residents might not have this if they're earning an income that's not employment income, let's say business income or investments. This one's focusing on investments. So if a Canadian company is paying out dividends and some of those dividends are going to a non-resident of Canada, the company will be required to withhold some tax amounts. Generally, we use 25%. If we have a specific tax treaty, that tax treaty might override that number and lower it. So for example, I have had clients who are in Canada and they have US investments. Those US investments withhold 25% of dividends for taxes, but I can file paperwork with the IRS saying this is an individual who lives in Canada, and they'll reduce the withholdings to just say 15%. And the reason they do that, we will get into more detail come chapter 7. But the point being is generally we hang on to some taxes just as like a 25% flat rate. Okay, so talking about those rules, do we want to be a resident? Do we want to be a non-resident? Generally, if I live here or if all of my income's Canadian, I want to be considered a resident so I can get access to all the credits. But if I live somewhere else and have other sources of income, then maybe I just want the Canadian income taxed here, and so I want to be a non-resident. So if I want to become or break residency, what is the government going to be looking at? Um, so they want to look at factual residence. The average Canadian individual has a job, family, and a place to live here. They might have other personal property. So they are looking, this is kind of going through a lot of words. I'm just going to try and sum this up for you. What we're trying to determine is, do you have enough residential ties? An average person considers home to be where their family is, where their home is, where their economic ties like work are. If I wanted to break residency, if I want to say, hey, I'm going to move to um, France, I'm going to move to France, but I still have a home here. If my wife and children still live here, if I still have bank accounts, a driver's license, if my life is still in Canada, even though I moved to France, I'm still considered a resident because too much of my life is here. So if I want to break that residency, I need to sever my residential ties. So an individual continues to be a factual resident if they don't sever their ties. But what we're trying to do is figure out what their intention was. If I move to France, but everything I own and all the people I love are still here, that insinuates there's an intention for me to return to Canada. And so it's still my home. The CRA and courts resort to objective evidence such as residential ties. So even if I say, no, no, I wanted to live in France, they're going to look at my ties and says, okay, but why is all your stuff still here? So the first thing they'll look at are called significant primary ties. These are three big things. One is, where do you live? Where's your dwelling? If a person leaves Canada and rents their former dwelling, then maybe that's not going to be considered your home. I'm just keeping it for income. That Canadian income's still going to be taxed as a non-resident, but at least I can be considered it's not my dwelling anymore. But if no one else moves in, if I just have a house and I'm leaving empty, well, they're going to argue you're probably going to come back to it. Who leaves a house empty? Where is my spouse or common law partner? Common law partner is someone I'm not married to, but I do live with. For the purposes of tax, spouse and common law are considered the same. So through this course, whenever I mention spouse, I mean spouse or common law partner. So if individuals living separate or apart due to breakdown in relationship, so they say, hey, you living in France, but your spouse is still here, I can say, we're going through a separation. I plan to divorce. They might say, okay, so although this person's legally your spouse, there's an intention for them not to be anymore. And then dependents. Are there any minor children who rely on me? If my kids are here in Canada and I live in France, how am I supporting them? Is there intention for me to come back and be in their life? So these are primary residential ties. For the purposes of this course, you want someone to have at least one primary tie, okay? So if we present you with a situation and a person has no primary ties, more often than not, that person's not is going to be a non-resident. Outside of those primary ties, if you have two primary ties, you're kind of generally considered a resident. So let's say we only have one. Let's say I have a house, but I'm not married, I don't have kids. They're going to look at secondary ties to try and pad up that connection. So these are used to support existing significant ties. They're not sufficient on their own to establish residency, and they're typically used where an individual may have strong ties to two countries. Maybe I have a house in Canada, but my spouse is in France. Okay, well, now I have these two primary ties. We'll look at the secondary to strengthen the argument for one country or another. So secondary ties are considering my personal property. Where's my car? Where's my health card? What country do I have a driver's license in? Am I still using a Canadian passport? etc. So let's take a look at a couple examples. So for exercise 1-5, a non-resident, Miss Lori Lacombe, is a U.S. citizen and they earn employment income of $70,000. They live in Washington. They are a resident of the United States for the whole year. Miss Lacombe does not believe she is subject to income tax in Canada. Is she correct? We're going to ignore the tax treaty. She has to pay taxes in Canada. They established that her employment income is Canadian. Even though she lives in Washington, she's crossing the border to go to work. That is Canadian income. It's going to be reported and taxed in Canada. So exercise 1-5, very straightforward. 1-6 is on page 35. Give it a second. This new chapter layout takes a moment to find its way. There we go. So residential ties, exercise 1-6. At the end of the current year, Simon Farr departed Canada to take an employment position in Ireland. He was accompanied by his spouse and children and brought all of his personal property. Due to depressed real estate prices, he was unable to sell his home at a satisfactory price. However, he was able to rent it to a complete stranger for a period of 2 years. Complete stranger is important because if I moved to Ireland and a sibling was living in my house, then that's not considered to be like a renter because that sibling can easily give me the house back. But a renter has certain rights to the property as a tenant, and so I can't just come back in and kick them out. So a complete stranger is important when you're trying to establish severed ties. He also retained his membership in the CPA. So we would look at his situation. So number 5 is straightforward. Yes, you pay taxes on employment income. Exercise 6, our spouse and children came with us to Ireland, so we don't have those ties in Canada, but we do still have the house. So initially we might think this is a yes, this tie exists. But remember, the ties are supposed to establish intention. We tried to sell the house, but we just didn't get an acceptable offer. We are now renting it. So by taking part in actions that show intention to sever those ties, much in the same way I mentioned, yes, I have a spouse, but we're going through divorce proceedings, it shows that we are in the process or attempting to sever ties, and those can count. For the personal property, came with us to Ireland. We got a job in Ireland, so that's where our economic tie is. But our social ties can include memberships to certain organizations, and we are still a CPAO member. It's our only tie, and it's a secondary one. So on its own, it's just not strong enough to say we still live in Canada. So we would likely determine that Mr. Farr lives in Ireland, is no longer a resident of Canada. Now, I mentioned about moving to France. Maybe I'm like, I'm going to leave Canada. I'm going to move to France. That's going to be my new home. And 4 months later, I'm like, I don't know how to speak French. I haven't made any friends. I'm thinking I'm regretting this decision. And I come back to Canada. Length of time absent is not a determining factor for residency. If an individual severs all primary and secondary ties, um, unless some indication is that the individual planned to return. So what this is saying is I can break and reestablish residency within the same year. I sold all my stuff. I got rid of my house. I moved to France. Goodbye, Canada. But then I found I didn't like it in France. I said, you know what? I regret this. I'm going back to Canada. You can have severed ties. We don't worry that you were only gone for 4 months. You severed your ties for Canada. So you have worldwide income in Canada up to the time you sever. You only report Canadian income while I lived in France, and I will report worldwide income from after I return to Canada. So temporary absence can exist, but you have to consider intention. So what they'll do is they'll look at, well, you moved away. How often did you come back to Canada? And were any residential ties established outside of Canada? So did you buy a house in France? Did you do any of the things that like, hey, I'm trying to build a life here? So they'll look to say, was this a severing of tie or was this just a temporary absence? So that's our next exercise looking at, and I think that is think it's just the next page. Here we are. Ooh, that jumped a lot. Where do we leave off at? 1-7. Sorry. The format of the e-text is different from the physical text, so just give me a moment to get back to 10. I'm looking for 7. Here we are. Temporary absence. Jane is a Canadian resident who's employed by a multinational corporation in Alberta. While she worked in Canada for the company, she transferred to the US in the state of Florida. Before leaving, she disposed of her residence and other personal property. She did not wish to move, canceled her Alberta driver's license and health card, closed all her Canadian banking accounts. Because her partner remained in Edmonton, she flew back to Canada once a month. After 26 months, 2 years, she decided that between the excessive heat of Florida and the increasingly volatile weather and the travel to maintain her relationship, she returned to Canada. At this point, her partner is not her common law partner, which means they aren't married and they didn't live together long enough to be considered common law. Would Jane be considered a Canadian resident for the 26 months she was absent? So we're always trying to look for intention. She sold her house. She sold all her stuff. That certainly demonstrates her intention to sever her primary ties. Got rid of personal property. She changed a position to Florida so she didn't have an economic tie. Canceled her health card. Closed her bank accounts. So I think the intent to sever ties was established. She's not a resident. She did return frequently, but her partner was not a spouse. So their relationship was not at a point to be considered a primary tie. And on its own is probably not enough to say, yes, there was intention to return to Canada. So with on its own, the frequency of visits is probably not enough. So yes, I would say that she is considered to be a non-resident for the time she was absent from Canada. I mentioned that you can break residency in part of a year. Either you came to Canada or you left Canada. So what we will do is we will establish a date, the date you came or left. And on one side of this date will be your worldwide income if you were in Canada. And after this date is only Canadian income. If you're coming to Canada, it's the other way. Only Canadian income, all worldwide income after. So when we consider part year residents, we're really trying to focus on when were these ties created? So a part year resident uses factual residency and is not deemed. Non-resident individual becomes a resident of Canada. Canadian resident individual severs Canadian residency in year. So either they come to Canada or they leave. The taxation year will be divided into two parts. Those two parts are worldwide income, only Canadian income. So when you leave Canada, we often look at the latest date of when the individual actually left, the date their spouse or partner left, or the date the individual becomes resident of another country. So basically, we're looking for, I moved to France, my spouse is going to come with me. Well, as long as my spouse is in Canada, that's where my tie is. So even though I've gone to France, my residency doesn't break until my family comes with me. But if I establish ties in the other country, in France, so I'm saying, okay, my family's come with me. Now that we're together, I will buy a house, set up bank accounts, do things to establish residency. They'll say, okay, well, until you did that, you were still a resident of Canada. So they'll look at the latest date. If you're entering Canada, the individual becomes resident on the day both a landed immigrant and provincial health coverage obtained. Basically saying, by the time when you come here and declare, hi, I am here, I'm on the record, then they say, okay, you are a resident now. I want to live in Canada, you're good. Um, so we have two exercises for part year residents. Mark is a Canadian resident graduated from university, was employed in Vancouver, accepted employment in the United States, and as of February 1st of the current year, flies to Los Angeles to assume his responsibilities. His spouse remains behind with their children until June 15th, the end of the school year. On that date, they fly to Los Angeles to join Mark. Their residence is sold on August 1st of the current year, at which time a moving company picks up their possessions and the moving company delivers it on August 15th. When do we consider his residency to be broken? So he left Canada on February 1st. The date of residency as a new country is February 1st. He started working at a new job, is starting to build some ties. His family doesn't join until June 15th. So that is the later. We look at when did he leave? When did his family leave? And even though his stuff, his house and his stuff was still here, that was just because it took time to sell the assets. The fact that they were trying to be sold is still in tension, and it's not looking at when did you sever the ties, it's looking mostly at when did you physically leave the country. So since he got the new job and moved to the new country February 1st, he's going to be a resident of Canada until June 15th. So from January 1st to June 15th, he will report all his worldwide income in Canada. After June 15th, since his work is out of country, he probably won't have to report any more income because he has no more Canadian income to report. We are getting a little long. I'm going to do the next exercise, then I'm going to break it, and I'm going to follow it up with a short video where we talk about deemed residency. Mr. Kirsch was born in the United States and until the current year lived in various parts of the United States. On September 1st, he moves to Alberta to begin employment. He brings his family, all his property. However, he continues to have a checking and savings account in the US. He obtained legal landed immigrant status on September 1st, but his health coverage was not obtained until December 10th. Explained how Mr. Kirsch will be taxed in Canada. So, one second. Did it say September 1st? Yeah. On September 1st is when his family, all of their stuff came to Canada. So when we look at the individual, the spouse, and when they started establishing ties, which is his new employment and all of his living arrangements, all of that is September 1st. So based on those ties, we would say his residency started September 1st. Now, if we wanted to, we could rely on the CRA guidelines to say he didn't get the health coverage until December 10th, so we'll make that our residency. The only thing is, the only source of income we are aware of is his new Canadian employment. So since he has to report Canadian employment anyway as a non-resident, it's probably in his interest to just use September 1st. We're going to use September 1st. All of the income's getting reported in Canada anyway after that date. And by doing this, will grant us access to those credits to apply against the income. So we could make the argument, it's not till December 10th, but I think we're fine just using September 1st as our benchmark for residency. Okay, like I said, this video is getting a little long. I'm going to break it here, but I will come back and continue the discussion on residency, focusing on those rules where someone can be deemed a resident.